Hello and welcome to Mark's Trading. Today we are going to talk about what is a trend. Now I know that sounds pretty basic, but before we even go into developing a trend following strategy, on a very high level, we want to just discuss what is a trend, what are some of the issues identifying a trend, what makes a trend robust in terms of giving you that confirmation to stay in the trend for as long as possible until two things happen. And there's only two reasons we're going to exit a trade. It fails, or it becomes extremely exhausted, overbought, where it doesn't warrant the risk any longer to remain in the trade, and we have a massive gain. So let's take a look. All right. Now, the obvious is just looking at any type of trend. We could see here we have Apple looking at the 200-day moving average, and obviously it's an upwardly sloping 200-day moving average. So the trend is obviously intact, it's strong. And we could see here when we say upwardly sloping that the 200-day moving average is just increasing nicely. But that in itself does not give us a really great signal in terms of creating a trend following strategy. 200-day moving average lags significantly, and it also might initially not get you into the trade quickly enough because it will lag a lot as well on a V-shaped recovery. So let's just go in and talk about what a trend is. So a trend defined is the trend equals a probability of success. So what is that? The trend probability is any trend that has a high probability of keep making new highs. Conversely, on the flip side, if it's a negative trend, it has a high probability of making new lows. Now, the trend equals any price change minus random noise. The more random and the more noise that affects the price of or the trend doesn't make a very good robust signal to remain in a trend long enough. So we'll talk about that in a couple slides. And lastly, a great signal needs to remove random noise for better confirmation of a trend. The issue is most indicators are all based on very similar momentum and price change, and that causes a high correlation amongst oscillators and indicators, and they don't diversify away from each other, and that's why they all have a tendency to mimic each other. So what is the issue with trend and trend indicators? Well, number one, the objective is we want to be in a trend that is very, very strong and ride that wave for as long as possible. Now, as we have mentioned before, the longer to be in a trade, the better, because if it's trending higher, we want to remain in that trade. Typically 70 to 150 days is where we want to be. But we want to be also proactive and get out of that trade if it's extremely overbought before there is some type of correction. And in terms of trend strength, the issue is the stronger the trend, the longer the look back period of price data. That's why a 200-day moving average is so robust. However, that look back period lags significantly. And the issue is it's already developed. We've already have been in that. And once it breaks, it's going to significantly break and take a long time and probably give back a large portion of those gains. So it's very after the fact in terms of looking at the strongest trends and the strongest gains. They've already developed. So that's a lot of technicals. trend following is not necessarily technical trading. Trend following is really identifying a new potential trade that is going to work in the future. And that's the tricky part, because there's no way to forecast if the trade is going to be explosive or not. That is why the trend following strategy is we take very quick, small losses early on and move on to the potential next opportunity. And we'll discuss that later on when we talk about the trend strategy itself. Also, strong trending indicators often lag too much. Why is that? Because it has much more of a smoothing mechanism to reduce price noise so we don't get whipped in and out of the market. So let's take a look. So here's an example of Apple, and we're looking at a 9-day, a 20-day, and a 200-day simple moving average. Now, I will certainly say, if you're not using any moving averages at all, they're better than nothing. They certainly are better than flying blind. However, they just lag too much, and there's not enough confirmation if you're using a number of different periods. I don't look at any moving averages whatsoever in terms of our trend following. Again, moving averages also are just historically taking the closing price, or they're taking the open price. So it's only one set of price series. I think it's really, really important that we use the open, high, low, close on a longer term time frame to remove that noise. But again, I'm not going to go into that right now. But as we could see here, the 200-day is very powerful in terms of its look-back period. The problem is it lags so much, by the time we get a sales signal, we would have significantly given back a portion of our gains. And a stock that has moved so far away from its moving average, let's say it's moved 3 standard deviations above its 200-day moving average, which would be overbought significantly. By the time even a 9-day moving average crosses its 90 or 200-day moving average, it will be too late. Conversely, even if we're using a 9 and a 20, that will whip us in and out of the trade. Even if we got back in early May, once they crossed, you would be out of the trade already after the fact. So it's very reactive, and it's not being proactive, getting ahead of prior to any massive correction. And the issue is you can't forecast volatility and you can't forecast a correction, but what you can do is look at all known information that's built into the price of stock and say, is there a significant amount of risk? And I'm going to show you exactly how we look at that. So what is the solution in terms of trend following? The solution is having a high quality signal. And when I say high quality signal, I'm not talking about some type of holy grail, high probability, get rich quick signal. There's no such thing. What a high quality signal is, it's the ability to remove a lot of noise. That helps you to stay in the trade. Remove that daily volatility. Give you a better picture and insight whether or not you should be in or out of that trade. Also, having something that doesn't lag too much where you've already missed that explosive move. Then lastly, providing some predictability into an early enough trend, grading the strength, saying the trend strength is strong enough, it hasn't broken out yet, but historically there is some predictability that the trend will keep advancing. All of this will give you a higher conviction trend following trade. Now, even if you're not a programmer and you think that you want to start developing your own system, well, there's a lot that goes into it. And if you can code, that's great. And if you're just going back 20, 30 years of just looking at a simple indicator, what you want to do is more data, the better. It allows you to see if that signal is robust or if it's just successful in a specific limited time frame. So you want to use as much historical data as possible. You have to also use out of sample data. And what do I mean by that? Don't initially just go back and look at 30 years of some type of moving average crossover. What you want to do is you want to look at, let's say if there's 30 years of data, you want to look at maybe the first 3 or 4 years. If it works, then go back and look at a following tranche of data. Maybe skip the next 5 and go to the previous 5 years before that. Because if you start looking at the data all collectively together, you're going to curve fit those indicators to fit your bias of what works and what doesn't. And what I will say is, from my experience of programming and testing modeling signals, is that it's almost impossible to alleviate the human bias, because when you look at some type of signal that doesn't work, you're going to go back and you're going to change it slightly to fit. And once you do that, the model almost becomes worthless. So that is really the issue. If you're not proficient in terms of back testing, it's really a very difficult exercise. So let's take a look at an example here of Apple and what we looked at before. And we have the 9, the 20, the 50, and the 200-day moving average. And we could see here that, well, the 9 certainly, if we were looking at that to get long, we would have gotten taken out somewhere in this area here. That wouldn't have been very helpful, and we would have had to get back up in here. So it's not giving us an extremely confident trend following signal. We can't use the 200-day once we pass that, because we would give back significantly a lot. We can't really use the RSI that most practitioners use for overbought and oversold, even with a 200-day or even a 50-day, because there's too much noise. Look at how it just bounces around. We went to an oversold level at 80, we worked it back off, went back up to 80 again, worked that off, went back up to 80 again, worked that off. That is what we call not robust. It gives us no real visibility into if we should stay long or not if Apple is overbought. So I don't like looking at RSI in conjunction with a longer term moving average. The 50-day, we would have gotten into the trade up here, and it really would have done kind of a poor job of getting us out of the trade back at around 104. So we missed almost 32 points here, and then we went back up again above it at around 10 points higher. So it didn't do a good job either. So I don't find moving averages to be great. They're not bad by any stretch of the imagination. If you're not using moving averages for trend following at all, I think it becomes extremely difficult, and it's better than nothing. Also, the MACD, while we had a very strong breakout back in April, the MACD was kind of just not giving us any kind of strong acceleration in momentum, and it kind of was bouncing around from the signal line and the fast line. And then it broke down here. We would have gotten out, and then the only thing it really kind of did was right when it broke down after the fact, it collapsed. So these are not very robust. They lag significantly. And I think it's hard to really have a lot of conviction using off-the-shelf moving averages and oscillators and indicators. What we have developed is something that is, I think, extremely robust in terms of trend following. So we have our rating value that measures the trend strength. And what we do is we do a 1 to 5 buy-sell rating. 1 is a strong sell, all the way up to a strong buy is a 5. Once we reach a strong buy, we can then see that these lines, which we will talk in further detail later, will max out at a 100. So that's the strongest of the trend it could possibly get. So it looks very good. I'm going to just remain in this trade until it completely breaks, or I use my counter trend model, mean reversion. So what happens is the more negative it becomes, the more buyers are stepping in, pushing sellers away, sellers are stepping out. And the more negative it becomes, it gives me greater confirmation to just keep remaining long until we have an extreme amount of risk or it starts to revert and become more positive. Now, we started to tap out and stop declining. Now down into a negative, you have a high level of risk. It doesn't warrant to remain in the stock anymore. So we're being proactive instead of reactive. And so there's no way to forecast a correction, but on a statistical basis, when we reach a massively low level of a negative 90, historically, it does not warrant to remain long in a trade anymore because most of the gains have been taken and there is a higher level of a correction. So that is really just what is a trend following. You could watch the video on the strategy itself and how to really think about developing a trend following strategy. See you soon.